Well, welcome to this webinar brought to you by Perpetuate Capital. I'm Ken Powell, your host, and over the next hour, we'll explore one of the most significant opportunities in wealth management, guiding retirement age business owners through their transition and succession planning. Well, a few housekeeping items before we proceed. Would you kindly introduce yourself in the LinkedIn or YouTube chat or comments, wherever you're viewing here today? Let us know where you're joining us from. And also, throughout today's webinar presentation, please utilize that chat and comment feature on your viewing platform to submit any questions or suggestions, supporting ideas that you may have for further dialogue with Brant. I'll bring those questions and comments on screen a bit later for Brant's insights and his answers. Well, with about 40% of small business owners being baby boomers, that silver tsunami represents a historic transfer of wealth and assets under management, creating unparalleled opportunities for financial advisors like you to position yourselves as a trusted guide. And our focus today is on helping you evaluate business sale alternatives with your clients, specifically diving into the often overlooked sale to employee trust, or ET. This innovative strategy has been enhanced by Perpetuate Capital's new fund, making it an even more compelling choice for business owners looking to preserve their legacy while securing financial benefits. Brant Bearden will unpack the IRC Section 1042 rollover from a wealth manager's perspective, so empowering you to confidently lead these discussions and remain integral to the transaction from start to finish. Many business owners who choose an employee trust transaction are tempted to move their sale proceeds to maybe a large wirehouse drawn by that organization's expertise in 1042 rollovers. However, this webinar equips you with the knowledge to retain those assets under your management. By understanding the mechanics and the benefits of ETs, you're going to be able to originate those conversations with your clients, offer them an elegant succession solution, and ensure their rollover assets stay with you. So let's dive in and explore how you can seize this generational wealth transfer opportunity while providing immense value to your clients. And so it is my pleasure to introduce Brant Bearden. He's a seasoned expert in mergers and acquisitions and ESOP advisory and private equity within the middle market sector. Brant brings over 40 years of experience in capital markets, having advised on hundreds of transactions across diverse industries. He's a general partner at Perpetuate Capital, where he leads efforts to provide structured equity investments and liquidity solutions for ESOP-owned companies. Well, I've had the pleasure of getting to know Brant through his involvement with FCCI, the Fellowship of Companies for Christ International, where I serve on the leadership team. And this past year, Brant provided valuable business succession training for our membership of Christian business owners at our international conference in Lake Tahoe, California, this past September. And Brant's career includes founding Bearden Handley & Company, a boutique investment bank specializing in strategic financial advisory for closely held businesses, as well as serving in leadership roles at firms like Kidder, Peabody & Company and Bateman Eichler Hill Richards. His academic credentials include a BS in finance from San Jose State University and executive education and strategic negotiation from Harvard Business School. So with that, Brant, it is a pleasure to bring you on, and welcome.
Thank you very much, Ken. Very much appreciate.
Yeah, absolutely. And Brant, I know you have been on the road a bit here lately. I think you're probably on the road quite a lot. But I know you were at Kingdom Advisors recently in Orlando, Florida. How was that gathering of several thousand financial advisors?
Yeah, it was great. It was huge. I couldn't believe that there were 2,700 FAs in the the ballroom. It was really, really big. I asked several attendees, is there content around business sales and succession and to a man? Everybody said, no, there's not. You really wish there was. And so that was kind of the genesis for two things. One is an actual course that we're in the process of building and submitting to Kingdom Advisors for their approval.
Oh, excellent. Yeah.
Credentialed course. And so, and then two, it's a highly summarized webinar that will kind of treetop a lot of those issues. And so looking forward to sharing this and helping everybody be even more successful than they are.
Yeah, well, I know we're looking forward to hearing about this today, discovering more about how these tax deferred strategies really work, maybe dispelling some common misconceptions out there, and maybe uncovering some lesser known realities that could serve wealth advisors on business sales utilizing the Section 1042 trade. So, with that, Brant, I will turn things over to you and have you take it from here and walk us through. Thank you.
Yeah, just I'm on the tail end of the flu, everybody. So if I'm hacking and needing to drink water, please bear with me as I get through this. I'll try to get through this in the goal is 20 minutes, 25 minutes, and leave ample time for Q&A on the back end because there always is a lot of questions. And so see if we can't get this thing. Here we go. So a little bit about Perpetuate Capital. Our firm is a specialized private credit fund and advisory firm that exists to perpetuate the impact and the independence of purpose-driven companies rather than see these companies sell out to third-party, most often secular private equity groups where the impact and the purpose of the purpose-driven company gets trashed. And so that's our passion. To date, we've saved about 320 million in capital gains tax on the sale of businesses and 78 million in annually of income that to government stays in the price of these businesses and can get invested the way that the board decides. The board of the corporation is the independence, and the board is perpetuated. Its control is retained in these transactions. Notably, myself, I understand your business very, very well, although it's been decades since I've been in the investment management business, the public investment management business. I was a institutional broker for Kidder Peabody, and so I totally understand the name of the game, which is assets under management. I, in 95, switched over to private equity from public equities, have sold many, many companies to public companies, to private equity groups, and to the employee trust structure. I'm an expert in the employee trust and in the Section 1042 rollover that requires your involvement. And so that's really the purpose of this teaching session, is to help you guys understand that this is really kind of the big why behind this opportunity and this issue that I feel like investment managers really need to get in front of. The blue line is the baby boom, which really began in earnest about 15 years ago. You'll see the arrow on the left, and then the arrow on the right is kind of where we are now. And so for the last 15 years, there's been, just an explosion of baby boomer aged business owners that are retiring. And so a subset of that blue line are business owners, private business owners. And I would say probably most of you, the majority of your assets under management are families and individuals that have privately held businesses, I suspect. And most of those are probably, baby boomer age guys, 55 to 65 now. And you can kind of see where the next 25 years is headed. I mean, it's just going to continue to exponentially grow. And these business owners need to sell the business often. Sometimes they can hand it down to family members, but not always. And so they are being seduced by private equity buyers, public buyers to a lesser extent, and don't know enough about the new and improved ESOP transaction, employee trust. I'll use employee trust, ET, and ESOP interchangeably. So this is the why it's so important for you guys to really kind of understand these alternatives from the perspective that I'll teach today. If there's a bigger AUM opportunity over the next 25 years of your career, I don't know what it is, because this is just like, gale force winds blowing in the sails of an opportunity for you to be aware of. And so, from your perspective, from the wealth manager's perspective, what's the best opportunity? I mean, when a client sells their privately held company to anyone and there's a big pile of cash for AUM, that's good, obviously. But what's great? So we're going to look at three different scenarios. One is selling to, if the client sold to a public company. The second scenario is if they sold to a private equity group. And the third would be if they sold to an employee trust and it was structured and financed by our firm, Perpetuate Capital. So we'll jump in here. So let's assume, I should be back out here. So let's assume that it's a 3 million EBITDA business valued at 6 times EBITDA, so 18 million enterprise value. Let's say the company has 3 million of existing bank debt on the balance sheet, so that 18 million in enterprise value is reduced by that 3 million, indicating that the equity value is 15 million. So the transaction value, the sale of the equity of the business, would be 15 million. The national average capital gains tax, all-in capital gains tax, federal and state, is 30%. Higher in some states, lower in some states, but that's the national average that we use as an assumption here. The capital gains tax is what's applicable if the client is selling stock to the buyer rather than assets. I've got a blended asset sale tax rate of 35%, national average. We've got this because private equity groups almost always want to buy assets and not stock. And so there's a little higher tax hit in those types of transactions that you'll see. And we'll just assume that there's 3.75 million of basis in the stock. Therefore, at a $15 million equity sale price, the taxable gain is 11,250,000, kind of across the board, all three of these scenarios. So column, you'll see that the purchase price is the same. Column 1 sells to public company. Column 2 sells to private equity funds. Column 3 is selling to an ET with Perpetuate structuring and financing it. And so the capital gains tax in a sale of stock to a public company is 3.4 million, leaves 11.6 million of AUM opportunity. Does the client have to roll over the sale proceeds into US stocks and bonds in that transaction? The answer is no. Is the board and the independence and the culture and the purpose of that corporation perpetuated? The answer is no. All new buyers, they take it in a different direction. Similarly, in a sale to private equity fund, a little bit higher tax rate because of that blended asset sale rate of 35%. So 11.1 million AUM opportunity. Same answers with respect to control being retained, independence being retained, and the need for the client to roll those sale proceeds over into US stocks and bonds. What's very notable is in the sale to ET, by electing 1042, which we'll unpack in the subsequent slides here from your perspective, uniquely, in order to legally avoid paying capital gains tax on the sale proceeds forever, the client needs to, within 12 months of the sale, roll over those sale proceeds into like-kind securities, US stocks and bonds. Very similar to 1031 in real estate, by the way, if you're familiar with that. So In so doing, all 15 million is the AUM opportunity, which is good news for everybody. They must roll those sale proceeds over into US stocks and bonds in order to affect this strategy, which positions you guys, I think, very, very well from the very beginning to help orchestrate the context and the thinking of the client to compare, make the decision in a comparative analysis like this, which I think is vital. And also unique in this structure is that the board, control of the board can be retained in this transaction despite selling 100% of the equity, which is very, very unique. And so purpose, culture can be perpetuated in this type of a transaction. Same data, and I'm just calling out here that in order to affect the 1042 trade, which is to roll the proceeds over into US stocks and bonds, it requires a 15% down payment, which is what I'll show you in this example, and an 85% loan to buy 15 million worth of US stocks and bonds, which I'll unpack. Now, you don't have to do it this way. I think this is the most elegant and flexible way to do it, but that 15 million can go, all of it can go straight into a portfolio of stocks and bonds, and you've satisfied 1042, and it's a simpler way to do it. But the disadvantage is that if you sell out a position subsequent to that rollover, it's going to trigger capital gains tax as to that amount of rollover securities that were sold. So it's a one-time, unlike 1031 in real estate, which is a multiple exemptions if you keep doing it. With 1042, it's a one-time, once in a lifetime exemption. So you roll over into US stocks and bonds, the capital gains tax is deferred until such time that you die. The basis steps up, the capital gains tax goes away. Very similar to 1031. And so Wall Street has created a very unique, elegant solution to providing a lot of optionality and flexibility for this type of trade, which I'm going to unpack now, but it requires a 15% down payment. So if you're the client, would you, and everything else being equal, $15 million of sale proceeds, would you rather pay the 3.4 million in taxes, never to be seen again, or the 3.9 million if you're selling to the private equity group, or keep all 15 million and tie up 2,250,000 for your lifetime? So what I'll describe in this trade is that 2,250,000 is tied up in a trade for their lifetime, and then when they die, that 2,250,000 is released to their heirs tax-free. All 15 million of sale proceeds is tax-free. So, like, just to kind of simplify it, would I rather pay 3.5 to 4 million in taxes, never to see it again, or compound with you, their wealth advisor, compound all 15 million over my lifetime and leave all of it, including the down payment, to my family? And so that kind of clarifies through some of the nuances, kind of the no-brainer basic decision. How do we comply with Section 1042? The way the law reads is that 3 months prior to the sale and 12 months subsequent to the sale, so basically a 15-month window, the seller must reinvest the sale proceeds into like-kind securities. There are a couple of rules. The publicly traded securities have to be, by the way, it can also be privately held securities, but the vast majority of people just do publicly traded securities because of the liquidity and the convenience. But the securities have to be stocks or bonds of U.S. domiciled corporations. Those corporations cannot earn more than 25% of their net income from passive income. Most companies satisfy that. An example of one that doesn't, for example, will be like McDonald's hamburgers. More than 25% of its income comes from franchise fees, which is considered passive income. So there's a few outliers that of securities and names that don't fit, but the vast majority of publicly traded U.S. operating companies qualify for the rule. And so because it's a one-time exemption, and if all you did was roll the sale proceeds into 30 equity names, 30 bond names, and when you actively manage that portfolio, when those positions need to be sold, it triggers tax. Wall Street has figured out a better way to do it. So in fact, the guy that really led the charge on Wall Street to solve this was former Treasury Secretary William Simon. He, for his own account, bought Avis Rent-A-Car, sold it to an employee trust, and went to his Wall Street friends and said, look, I need you to invent a type of a bond, a corporate bond called the floating rate note. So they're called floating rate notes, FRNs, or in the nomenclature, ESOP bonds would be another name for them. But these bonds are uniquely designed unlike other corporate bonds, highly rated paper. So you think A- or better in ratings. So like UPS, Procter & Gamble, Florida, utilities, big names. These bonds, so we know that in a normal corporate bond, there's a fixed interest rate at issuance, and then the price of those bonds fluctuate relative to and inverse to interest rates and also supply and demand. That doesn't work in this trade, because what the security that needed to be invented back in 1988, that thousands of sellers have purchased over all these years, needs to be a very, very, very stable bond, a very stable instrument. So designed, excuse me, to not fluctuate in value by design, so that one only needs to have a 15% equity position or a 15% down payment, and your margin department lends 85% against that portfolio of bonds that are very, very stable, so that you can buy 100% of what you're trying to buy without using all of the sale proceeds to do it. And so these bonds are typically 50-year duration bonds, which for a baby boomer age business owner, the bond will outlive him or her. They are puttable back to the issuer at par. And the interest rate that the bond pays is variable. So it resets every 90 days against 90-day SOFR rate. And so those design features combined create an instrument that barely moves by design, so that the margin department has very high comfort lending at such a high level, because it's not risky against that kind of an instrument. So this security was designed specifically for sale to ET transactions. And so the math on that, and there's another slide where I'll unpack it even more, but you, for this trade, you've got a $50 million in sale proceeds. You put $2,250,000 in a down payment. You borrow the remaining 85%, and you go buy $15 million worth of floating rate notes within 12 months. And that $15 million bond portfolio will pay you SOFR less 30 basis points of inflow into your account. And you've got a loan for 85% of that 15 million that you're going to pay margin interest rate of SOFR plus 85 basis points. So if you do the math on that, that's a negative carry of 64,275 on a $15 million trade. So not a hard investment hurdle for you guys to jump over by any means on an annual basis. But then the other thing that the way this normally gets to break even or even positive carry and positive cash flow is, rather than putting 100% buying all 15 million of floating rate notes, maybe it's 14 million of floating rate notes and 1 million of dividend paying stocks, where the dividends come in and wash that negative carry of 64,275 quite commonly. So again, I think the kind of the no-brainer Q&A on this is do I tie up 2.3 million of my sale proceeds that I get to leave to my kids and my grandkids at death, or do I flush 3.4 million down or even 4 million down the tax toilet, never to be seen again, and not allow all that money to compound during my lifetime? So kind of a no-brainer. We've already talked about the fact that William Simon was the one that originated these floating rate notes back in 1988. And so this is a little bit of a granular stepped example of that $15 million sale price to the ET, the 2.3 million being required for 1042. So you've got 12 million cash. So 15 million sale price in a perpetuate structured and financed transaction. That would be 12 million cash at close, and a seller note that the seller is carrying back of 3 million over some number of years. And attached to that seller note are warrants, penny warrants with cashless exercise features, so that the seller is maintaining 10% equity upside in the business for the next 10 years, having sold 100% of his equity. So it's a very nice feature, but you've got 12 million cash at close, 3 million in the seller note that's going to come in over time. By doing this 1042 trade, all 15 million is tax-free. So that's what he received. He's going to take that 2,250,000, the 15%, make the down payment on the bonds, borrow the remaining amount to buy 12.75 million. There's your 15 million of floating rate notes. Once and for all, the client has checked the box on 1042. And so now all the cash that they received, the 12 and the 3, is tax-free forever. So in this example, he or she's going to keep 9.75 million cash, tax-free, liquid, that you're going to manage. This 2.250, it's going to set in equity in your brokerage account It's going to earn probably 4 or 5% in an enhanced money market yield on the 2,250,000 over its life. So it's not going to grow significantly, but it's not going to it's not going to wither away either. It's preserved. And it allows you to now actively manage the portfolio and go into securities that do not qualify for 1042. So if you do the floating rate notes, you've once and for all checked the box on 1042. Now you as the wealth manager can manage that money across a spectrum of assets. You can be in real estate investment trusts, you can be in public or private equity, you can be in whatever you think is best from a portfolio management perspective. You've got the flexibility of having the ability to do that, having checked the box in this way. And now you're compounding all of the sale proceeds over the client's life rather than 70%. So excuse me, sorry about the flu. You bought 15 million of floating rate notes. You've satisfied 1042 once and for all. I guess this is the illustration of what I just said. I got ahead of myself. So your deposit of the 2,250,000 is earning whatever your money market pays. Your outflow, so your loan as to 85% of the 15 million or 12.75 million is SOFR plus 85 basis points. So that's a 5.2% annual interest rate. So in actual cash outflow, in this example, 664,275, offset by your inflow. So you're getting on all 15 million of those floating rate notes, you are receiving 4.05%, SOFR less 30 basis points, 600 grand. And so that's how we get to that negative carry of 64,275,000, which again can be neutralized by layering in some additional dividend paying securities or higher paying corporate bonds, for example. And so what does that result in? It results in the client saving all and compounding all of the sale proceeds, leaving the 2,250,000 in stub to his kids, like we talked about, all cash at close, all seller note payments that are received are tax-free, with one caveat. The interest rate, the interest income on that seller note is taxed at ordinary income rates. There's nothing that we can do about that. But the principal, which is the vast majority of those note payments, is tax-free forever. And so, and the client is receiving an attractive interest rate on his seller note. So that could be anywhere between 6 to 8%, let's say, and maintaining equity upside. So the right to buy 10% of the company for a penny and immediately sell it at the future appraised value 7 or 8 years from now, after all the transaction debt has been paid off, that gain stacked on top of the interest rate on their seller note is a very attractive return, typically like 12%. And I would say, perhaps, most importantly, the extent to which you have this knowledge, have the confidence to be able to have this type of a conversation with your business owning client, you're the thought leader, you're the orchestrator of this from the very beginning. And so the chances of another big wirehouse broker swooping in at the last minute on a sale to ET transaction and offering these floating rate notes is like next to zero, because you were in it from the very beginning and orchestrating it. And so it becomes a very strategic and strategic piece of advice, and very, very sticky AUM opportunity. And so I think with that, I will take questions. Well, here, I guess one last slide. One of the questions is, what type of business owners does this work for? And so we're looking for clients that have at least, sort of 2.5 to 3 million of EBITDA on the low end, all the way up to, 50, 100 million of EBITDA. We've done very, very large transactions. And so if you have clients that meet that criteria, manufacturing, distribution, services, this does not work well for high cyclical companies like construction or real estate related businesses. But like any company virtually any company that private equity is expressing interest in is a candidate for this alternative transaction. And we would love to jump on a call with you and the client. We'll have a pre-call before we do that, but step them through this kind of education in support of your practice. And so maybe I'll stop there and just field questions, what questions that might.
Yeah, that's great, Brant. And I know that, as you were talking about that $3 million EBITDA and potentially coming together with multiple companies to make that happen. But even as we're thinking that through, the question that comes to mind is, can the employee trust really pay the same price as that third party private equity for the company as they're thinking about that transaction? And how does that happen? How do we get to that number?
A great question. Yeah, that's a great question. And it's probably one of the, it's for certain top 3 sets of a sale to employee trust transaction. Is a lot of times people then turn selling to an ESOP or an ET can't sell for the same price that you can sell to an outsider. That is not true. The ESOP cannot pay more than fair market value, but it can pay fair market value. And so every deal I've done in the last 20 years has been equal to, or in some cases greater than, what private equity was willing to pay for the business. And so lots of past clients that will validate that. But if there's a term sheet or a letter of intent from an outside buyer, the ESOP can match that price. And so there's really no price concession whatsoever in selling to the ESOP. It used to be separate but related. It used to be that no price difference on the ESOP, but you weren't going to get the same amount of cash at close in selling to the ESOP that you could get if you sold to a private equity group. Now that our fund is in existence, our fund lends additional money to the ESOP trust. And so between what the bank will do and what we will do, the sum of those two equals what the amount of cash that you would otherwise get by selling to private equity transactions. So that's kind of the good news, the new sort of game-changing calculus in looking at ET transactions today.
And you mentioned that difference in the tax rate too, when you're looking at the sale to private equity as opposed to this ET structure. Why is that tax rate higher in the sale to private equity?
Private equity wants to buy assets. They don't want to buy stock. So they want to buy assets because they can mark those assets up to the purchase price and get more depreciation every year and a tax shield for themselves every year. So it's more advantageous financially to them. Also, from a legal perspective, if they buy stock, they're buying contingent liability. So if there's some downstream lawsuit that happens 2 years after they bought the business, they own that, and they don't want that. And so that's why most private equity transactions, almost all of them, are asset sales, which aren't taxed. They're not taxed as seller friendly as if you sold to a public company and you were able to get selling stock. You were able to sell stock. You had enough negotiation leverage to sell stock to a public company, which is not a layup. It requires a managed sale process to have the leverage to be able to do that. But that's, at least at capital gains tax, it's better than 35-40% in an asset sale. And of course, the best is no tax by virtue of selling to the employee trust, getting the same valuation, getting the same amount of cash at close, and rolling over those sale proceeds with you to affect all of it and compound all of it for the family's lifetimes.
Mm. And so those sale proceeds on that employee trust, are they ever taxed? Or, I mean, just to confirm. I mean, you talked about the profits, but no.
They'll get, if you sell your replacement securities, it will trigger taxation. If you never sell those floating rate notes and you die, basis steps up, capital gains tax goes away, taxation does not happen. Just like in 1031 in real estate. So it does not happen.
And so with that,
and
go ahead.
The government, both sides of Congress, the left and the right, both sides of Congress provide that financial incentive to we business owners to give us an incentive and a motivation to sell to the employee trust rather than selling to consolidators in the market that triggers layoffs. It negatively impairs local economies. And so it's maybe the only thing in America that both sides agree on, that it's just really good public policy for that to happen. If you can, and it takes the pressure off of Social Security, right? The employees that are, employees, participants of ESOP plans, ET plans, have 3.5 times the retirement assets on average than employees that only have 401ks. And so it's really good policy. And so we have these really, really advantageous laws that most CPAs haven't spent time thinking about, because the deluge of private equity chasing all these baby boomer age sellers. So if I'm a wealth manager, I've got business owners that's on my book, my book of business. The fact that they sell the business and there's a big pile of cash, that's good. I mean, that's a really good outcome for everybody. But how do you take it from good to great? If you can take it to great and you can really show the client how they can save this tax money and compound over their lifetime, everybody wins.
Yeah, particularly, I mean, as you talked about earlier, the desire to maintain that company culture and looking at legacy and family, being able to pass this on and maintain the truly the kingdom goals and perspective and intention that's there for the owner is just a huge value. So now some of these companies, they're probably a little bit smaller. Maybe they are not at that 3 million EBITDA. So if they are smaller, just walk us through that again. Maybe multiple companies coming together.
So one of the things that we're flexible about, and actually pretty interested in doing one of these, we haven't done one yet, but we'd love to do it, is if you've got a business that's maybe it's $1.5 million of EBITDA, not at on your way to 3, but you have a friendly competitor. Maybe it's somebody in your FCCI group or your convene group or your C12 group, and you're in the same industry, like-minded individuals, or maybe there's 1 million EBITDA businesses that can be in different regions. Heck, they could even be in different industries. But if they're like-minded, they want to lock arms and do a roll-up themselves, then we can help structure that and finance that in a way where each of those sellers is receiving a higher valuation than what they would receive if they sold on their own to a third party. They're going to get more cash at close than they would get if they sold on their own to a third party. And all of the attendant, they're going to be able to retain control of their board, direction of their business, retain control of hiring and firing. They get the tax-free sale proceeds, aspect of it. I haven't even gone into the fact that when you go into the ESOP structure, like 100% ESOP owned company no longer pays tax on its profits. And it's like, how could that be? Is always the question. Well, we know if it's an S corporation, flow-through entities, LLCs and S corps do not pay tax. The profits flow through to the shareholders, and the shareholders pay the tax at the individual level. Well, what you would have in the case of either a single company doing this, selling all of their stock in the way that we illustrated today, or even 2 or 3 locking arms in doing their own roll-up that we help support, 100% ESOP owned company at the end of the day, with a pile of cash to the sellers and modest seller notes, you've got an S corporation, a flow-through entity that does not pay taxes, that has, the shareholder does. You've got one shareholder, which is a retirement plan called an ESOP or an employee trust that doesn't pay taxes. And so that's how thousands of American companies have stopped the taxation on the earnings engine that is the corporation in this structure forever, permanent and entire.
Yeah. No, it's just absolutely incredible. And so the ability for a financial advisor to gain a even greater understanding and depth of knowledge. Talk, Brant, just as far as next steps. How would they get in touch with you? Yeah. I know that I saw the QR code there, but just walk us through that process of how you walk through that with them.
QR code, it's in the email, call, or text. Happy to do a follow-up conversation and a deeper dive than I was able to do in such a short period of time here. So that could take the form of, you've got a client that wants to understand this, and we'll do that. We'll take them through that over Zoom. Or if you've got a few prospective clients that are interested in the firm's book of business, we'll do a little webinar. We'll do this, more customized, more free flowing webinar for your clients. Happy to do it.
That's outstanding. And as you mentioned, the email will come out. So if someone wasn't on didn't register for today's webinar, they can, through that QR code, reach out to you. We can get the information will come out to them. They can get the slide deck and move from there into ongoing conversations. So, yeah.
Well, we'll do an email on the back end of this.
Yeah.
Probably tomorrow, sending this recording. And the ability to book an appointment to have further conversations.
Outstanding. Well, Brant, thank you. This has been great. Appreciate the insight and information, and look forward to all the opportunities that are ahead to continue to perpetuate the kingdom goals and perspectives and plans for these business owners as they step into this opportunity. So thank you, sir.
You can. Thank you for your leadership.
Hey, take care and get well. We'll talk to you soon. Thank you all for being here today and being a part of our webinar. And look for that email or reach out to Perpetuate Capital and Brant, and they'll be happy to provide you with more information as you go forward.
Thank you, guys.